Gold has still massively outperformed the stock market. Now, this is going to continue in my view. We're now down from 45. The Dow divided by gold was 45 in 2000. And now we're around 12. And in my view, we're going to fall to probably 0 or 1. Let's say we go back to 1. So what does that mean? It means that the Dow Jones index will be 10,000 and the value of gold will be $10,000. So 1 for 1.
There were 2 overnight revaluations or devaluations of the dollar. Now, what's happening today? So let's say that spot's at $10,000 an ounce when that happens. Right. They will say to you, and we're going to pay you $12,000 an ounce. But what's the $10,000? That's a spot contract on Wall Street. That is not reflective of the true fundamental value of an ounce of gold. But people believe Wall Street.
Right. The global financial landscape is rapidly shifting as traditional fiat currencies lose their purchasing power. Investors are increasingly looking to historical safe havens to protect their wealth from central bank printing policies. Egon von Greyerz, a distinguished Swiss financial expert, and Lynette Zang, an experienced precious metals analyst, emphasize that gold has massively outperformed the stock market over the long term, serving as an anchor during systemic monetary crises. They predict that the Dow ratio divided by gold, currently sitting around 12, will inevitably plummet back to a historic ratio of 1-to-1 within the next 5 to 8 years. This catastrophic adjustment means the Dow Jones index will collapse to $10,000, while gold climbs to $10,000 per ounce, resulting in a staggering 90% loss for traditional stock investors who fail to diversify. As fiat currencies slide toward absolute worthlessness, holding physical and redeemable precious metals remains the only viable strategy to ensure maximum individual wealth preservation and personal freedom. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Look at a chart here of stocks against gold. In 1980, stock prices, as the graph here shows, was about the same as gold, so 1 for 1. So the Dow index was 850 and the gold price was $850. Now that went down to, as I said, 1 in 1980 when gold was very high, and then the following 20 years it went up to about 45. So stocks were much more highly valued then and gold came down in price. But since around 2000, gold has massively outperformed the Dow. And as the graph shows, we're now down 70% in the US stock market measured in the Dow Jones against gold. So gold has vastly outperformed the Dow. If you add dividends also to the Dow index, it looks a little bit better, but gold has still massively outperformed the stock market. Now, this is going to continue in my view. We're now down from 45. The Dow divided by gold was 45 in 2000. And now we're around 12. And in my view, we're going to fall to probably 0 or 1. Let's say we go back to 1. So what does that mean? It means that the Dow Jones index will be 10,000 and the value of gold will be $10,000. So 1 for 1. We could also fall further. If we go down to 1, the ratio between the Dow and gold, we go down to 1, it means that it's a fall of more than 90% from here. So that is the amount of value that investors stand to lose in the next few years. It could be 5 years, it could be 10 years. I think it's more likely to be 5 to 7, 8 years than 10 years. So there'll be massive destruction of asset values.
This is money. It's sound money that cannot be inflated away by governments or central banks, because I actually counted 33 different global users of physical gold. So this is money, sound money. Then they came out with this, which is the gold certificate. See, it's got that little gold piece there, which is a claim on sound money. It's not sound money itself, right. It's a claim on it. And then they came out with this, which is a Federal Reserve note. And as we've already established, this is corporate debt. Now, I'm happy to send this to you, but I came across a link from a government agency showing how this whole kickoff happened and how they turned sound money into corporate debt. So I would also like to show you, for 20 years, these things all circulated every single one of these has a face value of 20 bucks, and they were treated the same. They're not the same. This is money, this is a claim, this is a promise to pay. Well, if you're used to this for 20 years, you think this is just the same as this. Yeah. And so when they took that away, nothing has changed. But not immediately, about a month after they took away the public's ability to protect themselves, they did a 69% overnight devaluation. Now I bring that up and your viewers might be going, well, that was so long ago. But they did it again in the 70s in the transition, and a lot of people don't realize this, but after the US took away foreign governments' ability to protect themselves, there were 2 overnight revaluations or devaluations of the dollar. Now, what's happening today? I do not think that Bitcoin being born in January of 2009 and quantitative easing being born in March of 2009, I don't think that's a coincidence. And that is a Trojan horse. And so they've gotten the level of adoption. And what happened? I mean, this is just a repetition of history. Yeah. This time is not different. It's the same pattern over and over and over again. So they just legalized it in July of 2025 with the stable coins. And that's why it has become my mission more and more and more to get redeemable gold. That may sound outrageous to you, but redeemable gold back in the system. So let's say that spot's at $10,000 an ounce when that happens. They will say to you, and we're going to pay you $12,000 an ounce. But what's the $10,000? That's a spot contract on Wall Street. That is not reflective of the true fundamental value of an ounce of gold. But people believe Wall Street. Right. I don't know why. It's just a big casino. It doesn't give you any true valuations, and it hasn't for quite some time. But most people would be fooled by that, unfortunately.
Historically, central banks have devalued currencies to mask systemic economic failures. Looking at transition periods of the past, overnight devaluations of paper assets stripped public protection while inflating nominal asset prices. Today, a similar monetary trap is unfolding through institutional mechanisms that obscure true value. It is predicted that when the paper spot price of gold on Wall Street reaches $10,000 per ounce, officials will offer to pay investors $12,000 per ounce. However, this paper contract spot price is merely a manipulated baseline set by a casino financial system, which is far below the real physical asset value. Wealthy elites will exploit this illusion, leaving uninformed public investors holding empty promises instead of tangible, debt-free gold. Understanding this critical discrepancy between paper claims and real wealth remains crucial as global currencies approach complete, inevitable collapse. Now, let's get back to the interview.
You've got to understand a rise in gold price is an indication of a failing currency. And if you get that, once you get that, well, frankly, you start to make different choices. Well, if we do that overnight reset, you can pay that off with dollars that in this country, but wherever you are, in fiat money that has zero value, which is exactly what the governments do. So you're following the government program. Somebody younger is not going to have that, and that's that same need. So all of our strategies are customized, and we love working with younger people and helping them. But at that point, they're just going to accumulate. Somebody that has established wealth, we need to make sure that they can always pay those property taxes, even if the house is paid off, because otherwise you'll lose the house, right? And we've got to keep that shelter over our head. Anything that is intangible and is in the system requires confidence and liquidity. But physical metals, that is the asset, right? Remember, this is the real asset, the sound money that has performed for thousands of years that governments and central banks cannot inflate away because it has the broadest base of buyer. That's why. It's not rocket science. And again, I'm going to remind people, it's not this one, this one. This is a claim on money, right? And this is just debt. What do you want to work for? Because I'd rather work for money. And that's why when you say I'm all in, why do I want to keep this garbage? I know what that is. And yeah, I'm not in stocks or bonds or ETFs or any of that, or cryptos, because all I can do is convert them back into this. What do you lose? Because let me tell you, we lose off of a gold standard, and if you don't hold gold, you lose your freedom. At the end of the day, that's what really protects, is your freedom. And what is that worth? A little bit of inconvenience. Yeah. A long-term chart on purchasing power versus spot gold. And so you see where it was fixed, but you have to understand that in the kickoff to the release and the confiscation, they created legally, right? 2.4 times the claims against the gold. Okay? So if people went to the bank with their gold certificates and asked for the gold, well, what would have happened then? So they took the gold away from the public. That was the same thing that happened in the 70s with the governments.
So if the currency goes down in value, it means that your asset looks much more attractive because it looks like the price of your asset has gone up. But it hasn't gone up at all in real terms. It's just gone up in nominal terms because the money is worth a lot less, and therefore you're actually getting less for your money, and your wealth is not as high as you think if you measure it in real terms. So we're going to have two devastating events hitting us in the next few years. They have already started, so we're just going to see the end of it. But the end, of course, is going to happen exponentially, which means that your dollar or your euro or your yen is going to go down also at a very fast pace. So your money will become even more worthless than it is now. And remember, as I said, it's gone down by 99% already since 1971. But the final 1% starts now. And of course, that 1% fall from now is 100% from here. So that is one disaster that is going to hit ordinary people. And everybody will be affected. Of course, if you have gold, you'll be compensated because the value of gold is going to remain constant as it always has been. Inflation is going to hit everyone, and it's going to hit everyone badly, and especially the people with very little money. They will find it very difficult to keep up with this increase in prices, and therefore they will suffer considerably. If we then look at the people who have assets, stocks, bonds, property, etc., we are seeing a bubble in all these markets. So we have an asset bubble that has been created by all the printed money that really started in 1971 when the gold backing of the dollar ended, and therefore the gold backing of all currencies, which meant that governments could print unlimited amounts of money.
The historic year 1971 marked a profound turning point when the gold backing of the US dollar ended, giving central banks unlimited power to print paper money. This unrestricted monetary expansion sparked massive, unsustainable asset bubbles across global stocks, bonds, and real estate markets. Interestingly, the concurrent birth of Bitcoin and quantitative easing in early 2009 served as a strategic Trojan horse to drive the rapid adoption of speculative digital currencies, further distracting the public from tangible assets. History is repeating itself as the fiat monetary system nears its final stage of collapse. While global paper currencies have already lost 99% of their purchasing power over the past several decades, the final 1% drop is predicted to begin immediately. Because this final decline occurs exponentially, it represents a complete 100% loss of remaining wealth for anyone holding cash assets. During this impending collapse, ordinary citizens, especially those with minimal savings, will suffer severely from skyrocketing everyday consumer prices. Meanwhile, physical precious metals will maintain a constant, highly reliable value as they have for thousands of years. Real protection lies solely in holding sound money rather than risky institutional debt promises. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.